Hello and welcome to this short Global Accounting Consulting Services webcast looking at IFRS 15, the new revenue recognition standard issued by the IASB and the FASB. I'm Tony DeBell, a partner in Global ACS, and I'll spend the next few minutes summarising one of the key aspects of the new standard, the accounting for variable consideration. The new model is based on a five-step approach. Management first identifies its contracts with customers and identifies performance obligations, the distinct goods or services that have been promised to those customers. Management then estimates the consideration it expects to be entitled to, known as the transaction price, and allocates that transaction price to each performance obligation. Revenue is recognised when a performance obligation is satisfied by transferring a distinct good or service to a customer. Let's take a closer look at step 3, determining the transaction price. The transaction price is the amount of consideration to which an entity expects to be entitled in exchange for transferring goods or services. IFRS 15 includes specific guidance dealing with a number of complexities, including the effects of variable consideration, the impact of a significant financing component, non-cash consideration, and so on. So when is the consideration variable? The amount that an entity expects to be entitled to can vary for a number of different reasons: discounts, refunds, price concessions or penalties. It can also vary if the amount is contingent on a future event. For example, consideration is variable when the customer has a right to return the goods, when there are potential performance bonuses, or when the consideration is based on a customer's future sales. This is normally described as a royalty. Variable consideration does not, however, capture uncertainty about whether the customer will pay. There is no contract at all if there is significant doubt about whether the customer will pay the amount to which the entity is entitled. This is part of step 1. Once a contract exists and revenue is recognised, any subsequent impairment of receivables as a result of customer default is recognised in accordance with the guidance for financial asset impairment. Now let's take a look in more detail at variable consideration. The transaction price is estimated using a best estimate or weighted average approach, whichever best reflects the amount to which the entity expects to be entitled. However, variable consideration is included in the transaction price only if it is highly probable that there will not be a significant revenue reversal. This principle is intended to provide useful information. That is, the IASB does not believe it is useful to recognise revenue that might be reversed in the future. IFRS 15 includes a number of indicators to assess whether it is highly probable that there will not be a significant revenue reversal. These include whether the variability is subject to factors outside the entity's influence, how long until the variability will be resolved, whether the entity has experience with similar types of contracts, and whether there is a broad range of possible outcomes. The minimum amount that is not subject to significant reversal is recognised and updated each period. For example, an entity sells machinery for 100 today, plus a bonus of up to 5% based on the machine meeting future efficiency targets. There is evidence at inception that it is highly probable that the bonus will not be less than 3%. Revenue of 103 is recognised as the minimum. Partway through the arrangement, it becomes clear that the whole bonus will be received. The remaining bonus of 2% is now recorded because it is now highly probable that there will not be a significant revenue reversal. What does this mean in practice? It means that some entities that previously deferred revenue recognition until all contingencies were resolved might now need to make an estimate and record revenue earlier. Others might find that the highly probable threshold is not met, so revenue might be recognised later than under current practice. There is an exception to this principle. IFRS 15 states that for licenses of intellectual property with a sales or usage-based royalty, revenue is recognised only when sales or usage occurs. The highly probable constraint does not apply to these transactions. This exception is not applied by analogy. It is only applied to sales or usage-based royalties arising from the licensing of intellectual property. It will be necessary to determine what is intellectual property, whether a transaction is a license or a sale of intellectual property, and what is a sale or usage-based royalty. These terms are not defined in the standard. The key message is that the elements of variable consideration and whether they should be included in the transaction price requires careful consideration and judgment. It is therefore not surprising that the disclosure requirements in IFRS 15 focus on this area. The results of this assessment could affect the timing and amount of revenue recognition, and the key judgments should be disclosed. These are just some of the highlights on how to account for variable consideration. An overview of the standard and more information on specific aspects of IFRS 15 is available through webcasts, an industry-specific guidance designed to help people start thinking about implementing the new standard. Keep up to date by following the news on PwC Inform.